Yeah, that's probably what I'd say.
I think equities will go down.
Yeah, no, I think it will. So.
All right. Oh, no, I just wanted to make sure that I'm recording this, so it's like in 2 different groups. All right. So what have you guys come up with? No, I know you don't have a perfect idea. Of course, I mean, you guys are just starting off, but you still need to come up with an opinion. So all I want is an opinion. I'm not saying give me the right answer, because nobody knows what's going to happen in the future. I just want your opinion. Oh, so do you want me to show you what the results were first? All right, so, okay. There you go. So those were the results. So this is 0.25%, 1.21%, 10.03%, 6.26%, 10.32%. So I want what you guys can.
So S&P is quite highly correlated to our international society. US, they're the fourth one. So I guess if we're already.
You got some? Oh, you working on your own, or you got some numbers?
I'd say. Yeah.
All right. Let's go with government. What do you have?
We have an effect.
Sorry?
We start from the right.
Okay. Emerging markets. What do you have?
We reckon 15.
15. Ooh. Somebody is aggressive. Okay. What do you have for developed? 6. Ooh. Cool. S&P 500? Sorry? Give me a number, man. Going down. From there. Oh, okay. All right. High yield corporate bonds. Generally, corporate bonds should have a lower return than equities. All right? And higher than government bonds. So if you're there, you can kind of now come up. So if you can give me this, we can put this right in the middle. So what do you have for government bonds? 4%?
Yeah, 4 or 5.
So what do we have over here? Yeah, done?
Yeah.
Cool. All right, next table. You guys have some numbers? Yep.
Sure do. So you said 5%. Yeah, 5% government.
Yep.
And then, oh gosh, what do you say for
All right, let's just go to S&P 500.
S&P 9.5%?
Developed?
7%. And then 12.5%.
Ooh. All right. Do I have something from table 3? I have low hope from table 4. My hope is going down, but do we have some numbers?
If you don't mind, can I also give you a second?
Yeah. I'm Tia's got some numbers. Tia. Come on, Tia, tell me.
5.
Okay.
And 7%.
Yep.
And 9%.
Yep.
Not 9%.
Yep. 11 or 12. And for you guys, I'm just going to put. Oh, okay, cool. All right, now, you guys did this in what, matter of a couple of minutes? Somehow, I get the feeling you guys are almost on the right thing. I mean, if you think about the consensus. Oh, sorry, I didn't get your number, sorry.
bones?
I've called you T1H.
Okay, great.
Yeah.
This is 0%.
Ooh.
This one is minus 5%.
Okay.
S&P minus, I would say, 8-9%. This is minus 15%. This is positive 25%.
Whoa. Whoa. Hussein has just blown everybody out of the water. We're going to come back to yours. Because in my mind, the rest of the forecasts are very similar. I mean, if I think about the first lines, you guys are pretty much on this idea that there's a lift in the bond market, and that lift is coming from sources such as high yields. Of course, you'll have drop in prices, but it depends on whether you're long-term or short-term. So short-term bonds will gain from yields, and long-term bonds will drop in because of yield changes. So I see this idea over here. You also have S&P pretty much around that mark where you're saying it's going to behave normally. So these are very normal numbers. I think these numbers are below normal, and the reason why you have them below normal, in my mind, I can't get into everybody's mind, is that you believe that Europe has still not come out of its financial crisis. Brexit has just happened. Grexit might happen, and Frexit might happen. Sorry, Grexit, Greece going out, Frexit, France going out, because you know France is going to have a new elections, and there's a lady by the name of Le Pen. And Le Pen is very similar to Trump and is very similar to May. They all have very similar ideas of protectionism. So the moment protectionism takes place, the advantage of Europe is going to go away. Hussein, on the other hand, is saying it's going to be worse than you guys think. This is going to be a bloodbath in his mind, yeah? And over here in the emerging markets, you guys have given a really higher, a much higher return. In fact, in your minds, all of you guys, except for you guys, what happened to you guys? You're still sleeping, aren't you? No, you're awake. All right, cool. You kind of look like sleeping. In your mind, your idea is that emerging markets has just suffered. It has had bad returns. It was hammered by issues that were facing the developed markets. So now that it's going to come out of that issues, they're going to do much better. Is that how you guys were thinking?
Yeah, with the rising dollar, with the depreciating dollar next year.
Hussein has slightly different ideas, but if you look at his direction, his trajectory, is pretty much the same. I mean, okay, yes, over here he's hammering the corporate, U.S. corporate and developed market corporate, but essentially his direction is still the same. Now, I am really proud of that you guys came up with that in a space of, what, 10 minutes? How would you improve this? If you had time, let's say I gave you a day, what would you do? You guys, what would you do if I gave you a day? No, don't say you're going to sleep or watch TV. What would you do if I gave you a day? Where would you go? Because keep in mind, this analysis cannot be done in a day. So that means you need to source information from people who know, who have forecasts. We're not training you over here to become economists. That is not our role. Our role is to use economists as your as the people who feed you information. So they are the ones who are going to give you how the future is going to be, and you are going to decide how much you weigh on that basis. So where will you get this information from? This is the future. I'm talking about forecasts. Where will you get these forecasts from? What will be your first source of forecast? Remember, this is for the US market, but regardless US or Australia, the first forecast will come from the same people, as far as I'm concerned. Where would that be? Sorry? Bloomberg. My thoughts are always listen to the central bank. Now, I believe in the independence of central bank. I believe they are independent. I know that there's evidence on the contrary that they are not independent, but I'll still go ahead and say they're independent. So I'll go to that. So and I'll show you this, how this works out. So if you go into RBA, so this is the Reserve Bank of Australia. The Reserve Bank of Australia provides monthly meeting outlooks. Hang on. Let me release this. Notice these dates: 5th January, 7th February, 7th March. A lot of these dates correspond to the meetings of the RBA. RBA meets on the first Tuesday of every month, except for 2 months. So they kind of meet on a monthly basis. Every month, they'll give you an outlook of how they believe the market is performing, not just in Australia, but also globally. So RBA is not the only one. The other one that I like is Federal Reserve. So, again, if you go into the Federal Reserve, Yellen's statements or the governor before her and the governors before her, they all have meetings and they release the minutes of the meetings, and in that they tell you exactly what they believe is going to happen in the future. They feel. So these are the sources which are, how would you say, inside the government in a way. Yeah. Where would you get more information from that is not related to government? If you believe that the government, central banks are not independent, where would you go for information outside the government? Sorry? Bloomberg? Where would you go in Bloomberg? What aspect will you look at in Bloomberg? Forecasts? Analysts. So basically what you want is to look at analyst reports. Analyst reports are available, as these people are mentioning, in...
Lower than Bloomberg, by the way.
Sorry?
Which is available on Bloomberg.
Yeah. Are we able to? I know there's one terminal that we have.
There's one terminal here.
Yeah, one terminal, but we have. I don't know who has the key to that terminal. So, but apparently we have one terminal of Bloomberg, and eventually we should be able to get that. So hopefully this semester we'll be able to get it. But till that time, where else? If I had the Google, where else can I look at for this information? The forecast. Who else would forecast? Other than people in this class, who else would need to forecast the future? Rating agencies could be doing it. Yes, and these will be doing economic forecasts, yeah?
The World Bank as well.
If I wanted to look at individual asset class forecasts, where would I go? For this, where would I go? Who would I ask? Or who would provide this information? Research letters are a wonderful source. So newsletters coming from research houses are a wonderful source. Another source that you can all look at is fund reports. Every fund report has an opinion about what's going to happen in the future. And I'm actually coming to these two sources. So the two sources I want you to follow, one is central banks and the other one is fund reports. Now, during your assignment, you'll be able to see both aspects, the fund report and the funds that you use. And so hence, both of them will be able to be done. Now, let's take not the extreme views of Hussein, but I'm going to take the views which are kind of in between over here. And I'm just going to plug them in. There you go. And now, I'm going to run my solver again. So my solver runs.
Sorry, just for the government it was 0.0025.
Oh, this one.
Yeah.
Oh, okay, sorry.
It should be. Yeah,
Sorry.
up 50 basis points, so not up. So I think I said it wrong.
Oh, no, that's all right. So let's just.
No. Sorry, it should be up to 50. 0.5%.
This one,
Yeah, yeah, yeah.
0.005.
Yeah.
All right, cool, got it. So let's run the solver, solve, okay. And now, notice this. Of course, because you'd given such low returns over here, you didn't get anything over here, but now you get a nicer allocation. It's kind of spreading out. Why did we not get anything over here? Again, the same problem over here. Now, this is based upon our forecast. We've done our best forecast as far as returns are concerned. Where can we put our forecast next? And the answer is standard deviations. Because these standard deviations are, again, dependent upon the time frame that you choose. And what I would recommend is to go with something which is more normal, that you acquire over a long period of time. So let's say about 20 years. That way, you can use the correlation over a long period of time, or 20 years, 30 years, the standard deviation over a long period of time. However, the returns, you still look at the forecast, right? That's, in my mind, is sufficient for this class. At a higher level, we can then start playing with how to play around with the matrices and the covariances and the standard deviation. But at this level, I just want you to think simple stuff, yeah? Because there are lots of kids over here who have a lower level and other kids who have got a higher level. Sorry, when I say kids, you know, we are all kids, you know. I mean, what do they know? We are the kids. We are the kids. They don't know anything about what it is to be a kid. Anyhow, so now, once we have done this, now we're saying, hang on, but this asset allocation is still not what I would like. And this is where we start forcing asset allocation as per you. So now, suppose I want to improve this asset allocation. What else would I like to see over here? As you noticed, we do want to have higher allocations to, or have some allocation to every class. So what I'm going to do is make some ideas over here, and that we can implement. So the first idea is, as Tristan was mentioning, that at least 5% must be in every asset class. Yeah? This ensures that you have a minimum level. Now, Tristan, somebody might say, why did you say 5? Why not 1% or 2%? And your answer to them is that anything less than 5% is too small an allocation. All right? So 5% has to be the minimum. All right? So go with that. The next thing that you want to add over here is that you want to perhaps think how much you want to invest in growth and how much you want to invest in defense. So let's start with defense versus growth. Sorry, what did you say your name was? I forgot your name. It's so long and difficult. Katrina. It's not too difficult. Sorry. Did I break your computer?
I hope not.
I hope not too. We can charge the university. Katrina, which assets are defense assets and which assets are growth assets? Of the ones that we were showing, we were taking a look at, which one of these 5 are defense and which one would you consider growth? A growth asset is one that predominantly will increase in value and should increase more than drop in value. Sorry? All 3 equities are growth. And over here, both these are defense, although high yield can kind of straddle between growth and defense. But we are just going to put, because they're bonds, we'll put this as defense and these as growth. So now my question is, what kind of growth versus defense do we want? How much in growth and how much in defense? Now this portfolio requires a return of 8%. An 8% portfolio cannot be a defensive portfolio. Defensive portfolios will have returns which are closer to the bond than to equities. In this case, this looks like a growth portfolio. So how much in growth and how much in defense? And that's going to be your next question. So suppose you start off with a 50-50. 50 in defense and 50 in growth. You might realize that a 50-50 defense growth, there's a name for it, by the way. The name is balanced portfolios. A balanced portfolio may not provide you adequate growth to get to 8%. And so you will change that from 50-50 to 60-40. And then to 70-30. Till here, we are still looking at a growth portfolio. This is balanced. And starting here, 20-80, 10-90, or 0-100, we have high growth. Yeah? So at this point in time, to get 8% return, what kind of a growth versus defense would you think is appropriate? That. You want 8% return, and I'll just show you the returns on every asset. So you notice that 8% required return, to get 8% return, I should be somewhere around this region, yeah? So, how much in growth and how much in defense you think should be appropriate? A defensive, 40, sorry, defensive? 6. And 94 for growth. So take a look at this. So you should be somewhere over here, right? So not balanced, but perhaps somewhere in this region. Yeah? Not that high, because we don't want the returns equal to the highest returning asset, and not that low that we are going more towards bonds. Where would you pitch this portfolio? Give me some, sorry? 30-70. So now we decided.
Could we change the bond back to 5%? Because that is what it was supposed to be. And it doesn't make sense when it's that.
Which one?
The government bond. Sorry, that should be 5%.
Okay.
I corrected myself.
All right, so
That makes sense now. Okay.
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 Oh, now I've taken money out of the high yields because high yields come with much higher risk, but the return is not that high. So you'll have to play around with high yields as well. All right, let's just do that now. Hopefully that should improve it. Ooh, nice. It's looking pretty nice now. Yeah, I know it's almost looking like a balanced 50-50. But to get 88%, the highest returning asset is 12.5, the lowest returning asset is 5. You're pretty much pitching in the middle. And so it could be that a balanced portfolio will work over here. If you're pitching more towards the higher growth asset returns, then you're going towards a more growth portfolio and less growth. But what that allows me to do is to think that if I want to have, let's say we believe that 40-60 is the appropriate portfolio, 40% in defense and 60% in growth. So why can't we add this as a constraint? So what we've done is we have added another constraint. The first constraint was at least 5% in every asset class. The second constraint is we want a certain amount of growth defense. All right? That, you know what that's going to do? That will allow us to take a limited amount of risk to achieve our portfolio, portfolio return objectives. All right, any other constraint that you want to put in? So in terms of defense, remember we have two kinds of assets. We have government bonds and we have high yield bonds. How should we split up this 40% between the two? I'm not saying you have to give a specific number, but do you mind if all of them are high yield, or do you mind if all of them are government bond, or is there a minimum level for one, a maximum level for the other? What do you reckon?
Well, we define minimum as 5%.
Yep. So do we want to put a maximum limit on high yields? Yes, Tia? Probably. So what we can always do is that we can constrain the high yield to remain less than a certain number. So we say no more than half of your portfolio in bonds should be given to high yields. All right? What we are doing is the way we are allocating or the way we are constraining our assets, we are also constraining our risk. If you allow high yields to be all the way to 40%, it means that you have more credit risk in your portfolio, not enough defense. If you only have 40% of government bonds, you are not getting the diversification within bonds across the corporate world. Notice what we are doing. We are trying to somehow allocate money into your portfolio, ensuring diversification and ensuring that all kinds of constraints are achieved that might be relevant for the investor. I can go one more level where I say, well, 60% is in growth. How much of it has to be in the US? How much should be in the US? At least half? Yeah? So US should be greater than 0.5%, yeah? Of the 60%. So greater than 30%. Emerging markets. Is there a limit to how much emerging markets can be? Can you have entire 60% of emerging markets? No. Is there a limit to how much you want to have emerging markets? As far as Hussein is concerned, he wants 100% portfolio in emerging markets, correct? Yeah. And not just in emerging markets, in GCC. In perhaps Aramco.
Egypt.
Oh, Egypt, yeah. Oh, congratulations. Your president was just free today. Yeah. So, I don't care. I just want to make money. Emerging markets, maybe, other than Hussein, other people might say that the maximum we want should be less than 20%. Now, what this means is that we can put in these constraints. So I'll just show you how to put in these constraints. So we'll go with the first constraint that was mentioned by Tristan, that every asset should be at least 5%. Over here, we have a constraint which says every asset should be positive weighting. So 0 or positive. We're going to change that and make it into a 0.5. So you just click change, and over here is 0.05. Now, what this does is it gives every asset at least 5%. So if I solve it, I still have an answer, and I have a beautiful asset allocation. Now, we decided we want at least 40% in defense and 60% in growth. So what I'm going to do is I'm going to start adding some more constraints over here. So here's where I'm going to add a new constraint. In fact, I'm going to make 2 of them. So first is going to be called defense. And the way I do defense is equal to this number plus this number. And I'll do growth. Did I spell that correctly? And this is going to be, I can just do 1 minus this number. Yeah? So I've got my growth as well. So I can put another constraint. This number should be less than 0.4, and this number should be greater than 0.5. I've just made 2 So what I can do is...
Sorry, wasn't our growth supposed to be 0.6?
Yeah, I've just done more than 0.5. Because if I have 0.4 and 0.6, I've just kind of made one variable over here. So I add this constraint that this number should be less than or equal to 0.4. Sorry, I should just say. It should be less than this guy. And this guy should be greater than or equal to this guy. Okay. So now I've got 2 more constraints. My defense has to be maximum of 0.4, and my equities have to be more than 0.5. That's all I've done. And let's try to run this. Again, I found a solution, and it's looking pretty nice. 40% over here, 60% over here. Nice. 5% across. Anything else that we want to do? And notice what I'm doing. As I keep on increasing my constraints, I'm actually making my portfolio more and more focused, not just about the future market, but also constraining my risk. I haven't made one asset class 60%, another 3 asset classes 0. Because the moment I do that, I'm saying I'm only investing in 2 asset classes. I will never be diversified. What this allows me to do is allows diversification and allows me to think about the future even though I don't know enough about the future. And that's the case with all of us. We don't know what's going to happen in the future. You can get information from various sources like the central banks, like the Bloomberg analytics and forecasts, from newsletters, but nobody knows the future. And if nobody knows the future, what can you do? The best forecast you can make, put them over here, and then manipulate this portfolio by putting constraints. All right? Any questions over here? Any questions? You guys are so quiet. I'm so worried about you guys. Any questions, ladies and gentlemen, from that table? You guys look comfortable? Alice and Lee? Cool. Dat? I know you guys are good. You guys look very comfortable, so I have no problem. I think you guys are all right. Yeah. Accounting people? All right. So now what we have done is we have tried to create an asset allocation. We have one more step to go, and that step is implementation. So what we're going to do is take a break, a 10-minute, 15-minute breather. What's the time, sir?
It's 5 to 2. 7 to 2.
7 to 2.
Yeah.
So we'll come back at what, 7 past 2?
Yeah.
And that'll make it 14 minutes? All right, cool. So I'll see you guys in about 15 minutes, and we'll finish off with the implementation. All right? All right. So what I went through was the asset allocation. I went through the asset allocation with you. So this part was where we have a certain portfolio, and we we decide how we're going to invest this portfolio. So at this point in time, we are still here, where we just created a portfolio. Why is this not? There you go. So our investment is so many dollars in each asset class. That gives you a percentage. This is your asset allocation. Now comes the decision, how are we going to invest those assets? Using funds. So this part is a simple setup where we show you that asset allocation decision is perhaps the most important decision. Most people believe that it's the mispriced securities, but over here we'll just talk about that the optimal mix between stock, equities, bonds, and other asset classes is what we are planning at. We've already discussed this, that we have various asset classes which have low correlations, and I show this in this graph where if you have some asset classes, you have a efficient frontier which is giving lower returns and has higher risk. But as you add more asset classes, so in this case I've added real estate, the efficient frontier moves up and to the left. All it's saying is you get diversification benefits, that means you move to the left, and you get higher returns because of the other asset class. So this also moves up. Then we come to the solver, and what I did was I took you directly into a 5 asset class optimizer. So this is essentially what we just did a little while ago with 5 assets. And this is what is going to be, as far as your assignment is concerned, 5 asset classes. All right? The asset classes are slightly different because the asset classes over here are all from the US market. In this case, I've shown you an exercise which is US market and international, but your assignment is restricted to Australian market. So the first 2 are from the Australian market. Sorry, first three are from the Australian market, and the next two are from the developed and the emerging markets. All right. So I'm not going to go through this topic anymore. I'm going to go through one more topic, which is the core asset classes, to have a quick discussion about these two assets. And there are a couple of overheads I just want you to focus on. The rest of it is pretty straightforward, given that you have background in fixed income securities. Have you done FIS?
Yes.
Have you done EVA? Or you're currently doing EVA? Beautiful. You would have this information. So we're going to talk about both FIS and EVA. Bonds and equities. This is the overhead that I absolutely adore. I mean, if you have, when you'll be doing advanced fund management with me, this is the overhead where a couple of questions for you. You remember that here? So you did that last semester? This semester. So we haven't shown you this as yet. This will come next week. But for me, this is the best overhead in the world. And I tell you why. Because it has two parts to it. The first part shows you the correlation between equities and bonds. This is only from the US market, all right? This is the correlation between equities and bonds over a long period of time. This is 38 years. Yeah? What kind of correlation do we have? A low positive correlation. Yeah? But when we look at the correlations during up market and down market, we notice a difference. When the markets are up, the correlation is low. The correlation is high. When the equity markets are down, the correlation becomes even lower. This is between equities and bonds. So we had this discussion that when markets go down, central banks try to reduce the yields, and that provides a differential pressure on equities and bonds. But the most interesting aspect is this aspect. This is monthly. Yeah, there was too much stuff came out. That's monthly returns. So in a month where equities market go down below minus 5%, that means you've lost 5% of your market value, the correlation gets even tinier, which means diversification benefits are best observed when equity markets collapse. There's another point that I want to make over here. If you have bonds in your portfolio, then you don't have to worry about equity market collapses. Now the question is, how much bonds should you have? And that should equate to how much protection you need. The more protection you need, higher should be your bond allocation. Okay? So that's your first part. The second part is correlation with realized inflation. So we're going to look at both equities and bonds with inflation. And why is this necessary to talk about inflation? Because our portfolio investment objectives are always to have real returns, right? And to have real returns, you have to have a link with CPI. So on this side, I have bonds with inflation and equities with inflation. And ladies and gentlemen, this is going to be an eye-opener for you. I know you might have preconceived notions about how these assets are related, but today you'll see something slightly different. First up, how are bonds related to inflation? And our answer is positively. How are equities related to inflation? Again, positive. Equity correlation with inflation is higher than bonds correlation with inflation. However, both of them are positive. But now what we're going to do is we're going to break them apart. We're going to talk about yields versus capital gains. In bonds, the capital gains are negatively correlated with inflation. Obvious, inflation goes up, price falls. And income is positively correlated. Yields go up, you get more coupon interest. Yeah? So these are pretty straightforward. However, the interesting aspect is also this. The real returns are negatively correlated with inflation. So when inflation goes up, if you have money in bonds, you actually lose in real terms. So this idea that I can protect myself by keeping money in safe investments such as bonds is a bad idea, because what that means is you will lose against inflation. All right? Especially when inflation goes up. When inflation goes down, of course you gain, but inflation goes up, you lose. And normally, do economies want inflation to be, okay, I think this would be a bad way to start off with. In Australia, the target inflation is between 2.5 to 3.5%. Central banks target that. When the inflation is below this level, it is a problem for the central bank and the government, because that means the economy is not growing at the right rate. So they'd like to increase this inflation. For developed economies, we have the problem that our inflation tends to get too low sometimes, and we want to increase it. With emerging markets, your inflation is the other way around. It's too high, and a lot of times you have to control it. So it's a very interesting aspect. We are always trying to have positive inflation, and by that definition, bonds are not something that will gain. They are used as defense, and that negative relationship shows that defense. With equities, the game is very interesting. First up, this part, 0.31, what this says is this: when inflation goes up, it improves equity valuations. Sorry, when inflation increases, equity markets increase as well. It is kind of an indicator the economy is growing. Where is this difference coming from? The correlation between inflation and income is almost zero, which means that companies earn based on their markets, and those markets are looking at just what is being consumed in this 1 year period or in a short-term period. They're not considering the long term. So yes, there are contracts, especially in resources. The contracts are very long dated. You can have 4 or 5 year dated contracts. But for most assets, your income is based on what is today, and that income is based on pricing of the assets, and the pricing of the assets is based on inflation. So when markets are up, you can price assets at a higher value, and you can also get revenues. When markets are falling down, when economies are slowing down, one of the things that most companies try to do is reduce their prices so that they can still be able to sell. So there's a high, so that's the idea. However, this implies that inflation does not impact your revenues. Firms are able to earn based on current market condition. But this part is the game changer. It says when inflation goes up, it is the capital gains that influence the valuation of the assets. It's the capital gains that go up. Now, for most people, they think that, oh, when inflation goes up, the discount rate goes up, and when discount rate goes up, when I discount back the dividends, I'll get a lower price. That's the general assumption. However, what we are showing you over here is this, that when inflation goes up, it actually increases the value of assets as well. This final line is the key over here. It says real returns on equities are very small correlation, not correlated with inflation. And this line tells you something important about equities. It says that equities are considered a hedge to inflation. A hedge. Now, I understand that you might think about hedge in different ways, so I'll just show you what you generally think about hedge. So what you think about a hedge is that, and this is coming from your derivative course. If you have done derivatives, if you've not done derivatives, you must have studied futures or options in Principles of Finance, so you should remember from there. Your asset is generally considered a long investment. So here's a long investment. Here's my value and payoff. Yeah? And this is the price today, P0. So if the price goes up, I gain. If the price goes down, I lose. Yeah? Everybody understands. This is what a long position means. How do you hedge this? You hedge this by looking at a short position in in a future perhaps. So this is S, not S, and this is my future. So this is how you consider a hedge. So hedge is something eventually which will give you a constant return. Yeah, so you reduce the negative side and you only get the up. How do you interpret this? How do you interpret this? What this says is, regardless what happens to inflation, equities will perform in a certain way. Their performance is not dependent on inflation. Inflation can go up or down. It doesn't matter how equities will perform. We know how bonds will perform, but we have no idea how equities will perform. There's almost a zero correlation. So again, this goes to the same idea of income over here, that the returns from equity, very similar to income, is uncorrelated with inflation. However, the capital gains and losses are correlated with inflation. Inflation goes up, economy improves, you'll get capital gains. Economy falls down, you'll have losses. With bonds, we see it very clearly over here. Inflation goes up, you will lose value in bonds. But when inflation goes down, your bond value will go up. And that tells you that this can hedge the downside of an economic condition. So I can put a floor on my portfolio based on this information. Good? Questions, anybody? So in my mind, if you get enough, if you can understand this overhead, that is most of my part of asset allocation, that you understand you have to have equities and bonds in your portfolio. You cannot go with this idea that, oh, I'll just have equities or 100% or 90%. You must have bonds in your portfolio to give you coverage. All right. Not interested. I'm going to go back to the first part. This is the first overhead, and I'm just going to look at a couple of bits that are the last or two overheads that you have. That if we have to implement this asset allocation, how do we choose funds? And the question is, do I base it on past returns or future expectation? A fund is a managed portfolio. This is from the first section. Just at the end of the first topic. Just the first one. Yep. So this is the first part, section 1, last three overheads. Yep. Section 1.
Number 7.
Yeah, beautiful. 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 Yeah. Yeah. How do I work out what to invest in? And that means the choice of a fund. How do I choose the right fund? I've given you this idea that, well, choosing the right fund has to be based on some information. Nobody can come and say, oh, this fund will perform the best in the future. All we know at this point in time is how the funds have performed till today. We also know who the fund manager was. We also can find out, if we want to, how did that fund manager invest. But that's all we know. We know just the past. How do we use that past to make opinions about the future? And the answer is going to be based upon something that you will all face. Not you, sir. You're already facing it. Not you either. You're probably facing it right now. But the rest of us, or rest of you, will face. And that is when you go for a job. When you go for a job, all the prospective employer has is your application letter, your CV, and your transcript. How do they decide whether you will perform well in their company in the future? How do they decide that? What do you reckon? I know, you probably work for people, you've hired people, so you probably know this idea, right? And probably you too, yeah? But for the rest of you guys, what do you reckon? What happens? Do you know, for example, I'll just give you an example. Do you know how many people graduate from a finance course, finance degree from universities across Australia? How many people graduate every semester? There are about 20 universities in Australia. Imagine every university has 100 undergrad and 100 postgrad students. I'm giving the conservative estimate. There's 200 students. 200 times 20 is 4,000. 4,000 times 2, because there are 2 semesters, is 8,000. So there are 8,000 graduates coming in every year, right? And there are not 8,000 jobs created every year in finance. And these are people who are just coming in. So imagine other people coming from outside, you know, people go and study overseas, people from overseas get immigration, come over here. There's a lot of competition. How does an employer judge? What do they do? What do you reckon they do? Rakib, tell us your experience.
So just practice, you know, call for the interviews.
But before you, how do you call? Because hang on, I'll just give you an example. There was an internship that was offered by the University of Adelaide, just from the University of Adelaide. And do you know how many people applied for that internship? Internships are free. You don't get money for it. How many people applied for it? 150. Do you think they're going to call 150 people? No. So how do they start selecting the people?
I think they should have a system, you know, that in order to screen the CVs, number one. Number two, they have to then get deeper into the CV and the cover letter.
Good.
In order to assess the quality of the candidate.
Good.
And after that, they will have a second round of or a first round of interviewing.
So how many, if there are 150 people, how many do you think will be?
I would say out of the 150, 15 will be shortlisted.
Perhaps, even that, I think.
135 would be in the garbage bin. Out of the 15, I would say that just 10 or 7 will be called for an interview. And out of this 7 or 8, just might pick up 1 or 2.
Yeah.
Or maybe nothing.
Please don't get disappointed. Do not get disappointed. This is reality. I've gone through it, he's gone through it, he's gone through it, and you'll all go through it. The only way out of it is make sure you choose a father who's extremely rich. And if you cannot choose that, if you don't have a choice of your parents, then unfortunately you have to do exactly what Hussein is saying. Go through that process. Now keep in mind, what are the people looking for? They're looking for a person who'll do well in the future in their organization. So first, that person has to have a fit in the organization, has to have the skill levels to do that. How can you judge that? Only from a CV, only from a transcript? Because in a transcript you have some kids who have got very high grades, but that might mean, that may be the case that they may not be suitable in the role that is being advertised. They might have the best grades. There could be other kids who may not have the best grades, but they have other skills. They might have other interests, which makes the employer believe that, yes, this is the person. So the only way, no, it's true. It's true, ladies and gentlemen, this is true. The only way for a person to judge the suitability is, as Hussein is saying, to understand that candidate. You cannot do it on a transcript only. You cannot do it on a CV only. You cannot do it on a app letter only. You have to talk to the clients, to the prospective employee. But that's the same thing over here. Exactly the same thing. A fund manager is like a student. The fund management card, their fact sheet is their CV, is their transcript. And you have to now decide on that basis of transcript. So when somebody is going for a job interview, would you only look at the GPA? And the answer is no. You'd probably look at relevant courses, right? Similarly, in a fund, you cannot just look at average past returns. They mean nothing. So that's what I've tried to say, that past performance may indicate the future if the returns of the funds are higher than the returns of benchmark on a risk-adjusted basis, evaluation over time period. But what we're going to do is, we're not just going to understand the fund performance, we're also going to understand the fund manager. Because the fund manager is the one who's running the fund. All right, so most of the time we consider some idea where we adjust for risk. And the way we adjust for risk is by entering a benchmark. Now, you guys have the same thing. When we look at, when you get a GPA, there is a benchmark. What's the benchmark? Generally, it's the average, right? And you say anything, if I'm above average, I'm better than the benchmark. It's the same thing over here. Now, does the benchmark or the average come from across different universities? Perhaps, but generally we consider benchmarks. So when I get, suppose you go for a job and you say, "Cool, can I put your name as a referee?" And I say, "All right, cool. Did you get a distinction or a high distinction?" You say, "Yes, I got a distinction." Cool. I'm happy to put my name on the referee list. So when the person calls me up from your prospective employer and say, "Well, what do you think about this lady?" And I go, "Well, she performed in the top of her class. When I look at her assignment, she did this, this, this in her assignment. When I look at her exam, she showed me this aspect. And that's why I think this person is capable." So my reference, my referee report about a person is as important as your transcript. And if you don't have a reference, chances are you won't get hired. So you need to have somebody who says, "Yes, this person is good." Similarly, we need somebody to say, "These funds are good." And who's that person who tells us that? Who tells us about funds?
Yeah, no, I think that there are some rating bodies, that would give you a rating.
Yep. Give me some names.
Dow Jones, for example, give you a rating.
Does it for funds?
Yeah, they do for funds.
I didn't know. For funds, I thought Morningstar does it.
This is in Middle East.
Oh yeah. Oh, okay. Yeah. Morningstar is the primary source of fund reports, and then you also have Lipper, and there are quite a few databases that evaluate you. So somehow you need that reference. Another source of reference for funds is advisors or analysts. They'll say, "Well, this is a good fund." But perhaps the best recommendation for a fund, if I ask you which is the best university in the world, what would you say for finance? Harvard, Yale, yeah? London School of Economics, Penn State, Chicago School of Business, and you can start naming these schools. Sorry? No, actually Europe is quite advanced. The difference is, in Europe they're more focused on math, and in US they're less, there's more corporate finance. So slight differences, but I think they're fantastic schools in France, in Spain, in London, UK, etc. Anyhow, so how do we know that? So we need that level of somebody to tell us that they are good funds. So what we're going to do is, we're going to look at risk-adjusted returns based upon not just a benchmark, but against a comparison universe. So you're going to look at all the other funds who work in that same space. So what we call peer funds, right? So this is where I move to the overheads that you guys have in your hand. So when you want to implement a portfolio using mutual funds, you have to understand how the mutual funds are set up and how they provide information. But before you even get to the implementation and choice, you have to decide what is the index that is relevant for that asset class. Index, as we discussed at the beginning of this class, tells you the exposure for that asset class. Indexes for each asset class are similar but not the same. S&P 500 index, MSCI US index, Russell index, CRSP index, they're all for the US market and probably all for the large caps. but they're not identical. They may give you a similar answer, but they're not identical. So that's fun. We first select the index, then we decide what kind of strategy do we want to have for that setup. Do we want active or passive? Now, everybody understands active investment, right? What is active? How do you define active versus passive? What is the difference? Sorry? Outperform the benchmark. And how do you outperform the benchmark? Identify mispriced securities. Simple. So the moment I am able to understand that there are mispriced securities in the market and I can identify them, I can have an active investment. When I can't do that or I don't want to do that, it will be a passive investment. All right? And then over here we'll decide on the level of risk. So if I want to have an active fund manager, I'll define how much active risk this fund manager is going to take. Active risk is the same thing as tracking error, but only in active investments. So in passive investments, we don't have active risk. We just call it tracking error. It's the same measure. There's no change in how it's measured, but we just use the term active risk for active fund managers and tracking error for passive fund managers. It's identical. They're identical terms. So some of the indexes, I wanted to show you these indexes. These are the well-known indexes of the world. We have the S&Ps, the MSCIs, the Russell, S&P, MSCI, CRISP. The most, I should have put Russell over there as well. 1,000, 2,000, but I should have put that there. But these are the most well-known indexes for the US market, equities only. And what I wanted to show you was that why are they different? Before I get on to that, when S&P makes an index, why do they do that? Why do they create an index? Who cares? Seriously, no. Why would somebody make an index? Do they gain anything out of it? Sure, that's what how you define or describe the index. But why is the index created in the first place?
Be the market portfolio.
To be the market portfolio, great. And because, as you know, that market portfolio requires investment in every asset in the market, it's not possible to create a market portfolio. So you have to make something which is investable. And not just investable, but also exposure. So all these different players come in the market to provide those indexes. My next question is, what's in it for them? Why would S&P create an index? Or why would MSCI create an index? Or why would CRISP create an index? CRISP, actually we know, CRISP was started off by these people, it's from Chicago School of Business. It is for academics. So CRISP is started off for academics and is now available for commercial purposes. But S&P and MSCI are only commercial. Why would they, what is the advantage they get out of it? And that's the answer. They get fees. Every fund manager who uses an index will pay fees to these fund index providers. And so there's a competition in the industry. Which index is going to be followed? Now, I'll give you a very interesting example. These are the two largest indexes, right? Largest index producers. Do you know the largest fund complex in the world? The largest fund complex, a company that has the largest amounts of funds in terms of assets under management.
It's either Vanguard or Blackstone. BlackRock.
How do you guys know this? Who told you this? Very good. It is BlackRock. It is BlackRock. BlackRock is the largest fund complex in the world. What's the second largest? You guys just answered that as well. Vanguard. The difference? BlackRock produces essentially active investments. Vanguard, all the investments are passive. That's the only difference. Now that you know that Vanguard is the second largest, what benchmarks does Vanguard follow? And at a certain point in time, for international portfolios, Vanguard was following MSCI. And they decided that they're not going to go with MSCI any longer. They're going to move to CRISP. What happened was that Vanguard was providing half of the revenues to MSCI. So when Vanguard moved away from MSCI to CRISP, MSCI lost, CRISP won. All right, so there's an advantage over here. Notice that no two producers will provide exactly the same index. It doesn't make sense. So there has to be difference. And here's the difference. S&P provides indexes that are more related to exposure. MSCI produce indexes that are more related to liquidity. That means they ensure that they're investable. Now, once they produce that, guess what happened? S&P said, all right, I'm going to produce an index that will be the investable index. And MSCI said, oh, I'm going to produce an index that is more exposure. So the number of indexes all these guys produce have kept on increasing. Now, this is one aspect. The second aspect is method of construction. How do they construct these indexes? All of these indexes are cap weighted. Cap weighted means the largest assets get the highest weighting. There are some upsides to this and there are some downsides to this. The upside is that it follows the market portfolio construction method that you just mentioned. The market portfolio M, you know, the one that you guys are all, you remember from Markowitz. So you have this, remember this market portfolio M? The idea behind this was that it consists of all risky assets in terms of capitalization. So when S&P, MSCI produce an index which is capitalization weighted, it is trying to reflect that M. All right? But not all indexes are capitalization weighted. For example, CRISP produces some indexes. CRISP produces some indexes that are equal weighted. What's the advantage of equal weighting? I think we had this discussion about ASX 100 and ASX 200, that as you go from 100 to 200, the next 100 get very small weightings. Well, to improve that, CRISP produces equal weighted indexes. That means every asset is given equal weighting. And one of the indexes that I haven't listed over here is the Dow Jones Industrial Average. And Dow Jones Industrial Average is a price weighted index. It's not a capitalization weighted index. It's not equal weighted. It's price weighted. But that is because there are different reasons for those indexes. MSCI has produced an index which says, well, if you want liquidity, invest in my index. S&P is producing an index which says, if you want exposure, this is how you get the exposure. Invest more in larger caps. CRISP is saying, look, if you want equal exposure, invest in an equal weighted index. And Dow Jones is saying, if you want to have the exposure to the largest caps, then invest in me. But the way we do it is one share of every firm. That's how it is done. When we talk about passive funds, we also look at how that is going to be created. And there are a couple of terms over here: full replication, sampling, quadratic optimization, etc. These, not that you have to worry about it, there are different methods to construct an index fund. Some are better, but they cost more. Some are not as good, but they cost less. For example, full replication implies that you buy every asset in the index, which is a lot more work, and hence they cost more. Sampling, on the other hand, says, well, we are not going to be exactly like the index, almost like the index, and on average, most of the time, we'll be equal to the index. But this costs less. So you can think about cost while making these investments in funds. I just thought I'll list some of the, I know this looks ridiculous over here, but these are bond indices that you probably are aware of because you studied FIS or will. Again, it's different kinds of indexes. Notice how many indexes are there just in the US. I just taken some of the larger ones. When I was downloading the data, I had a choice of about 3,000 bond indexes just in the US. 3,000. These are just the indexes. And every index has a different exposure, a different outlook. They tell you something different. So please don't think that any index, if you're beating it, that fund is good for you. No, you first have to define which index is relevant for your portfolio, then choose a fund that is relevant to that index. Almost to the end, so I'm just the last couple of overheads. When you're talking about a fund, and we're going beyond this idea about performance, we're going beyond that. We're saying, first let's try to understand what kind of a fund is it. Is it open-ended, closed-ended, or ETF? I know you have gone through this idea. Open-ended funds are funds where you can put money in and take money out. These funds are liquid for the investor. However, they don't trade on the exchange. Closed-ended funds do trade on the exchange, and you can buy and sell them anytime. And a lot of these closed-ended funds are real estate investment trusts. So these are all closed-ended active funds. And then you have ETFs, exchange-traded funds, that are funds that trade on the exchange. So they're closed-ended in a way. However, they're always indexed. So I think I have yet to come across an ETF which is active. So I've only seen passive ETFs. So they're just index funds that trade on the exchange. So a couple of ETF providers, one of them is Street Global. There's one which is called iTrax. There's iShares is another. I think you guys saw that in one of my tutorials. Each one of them come with a certain aspect which is important. For example, open-ended funds will always be more expensive of an equivalent closed-ended or ETF. Open-ended funds can be both index or active. So active funds and open-ended, and the same active fund and closed-ended, the open-ended will be more expensive. Simply because when you put money in, fund manager has to do work. When you take money out, fund manager has to do work. In closed-ended, he doesn't really need to worry about cash flows. An open-ended index fund will always be more expensive than an ETF on index fund. Always. In fact, ETFs will be half the price, except you have less choice in ETFs sometimes. So that is the aspect of fund type. Then history. This information is extremely important. It doesn't mean that you know exactly how the fund will perform in the future, but it'll give you some indication about the fund. For example, age. What can we say about age? Well, in my mind, if you're older, you're more beautiful. But that could be just us, yeah? Age implies that a fund has been existing for a longer period of time. The more mature a fund, longer its existence and longer its track record. In the fund industry, an average age of a fund is about 7 years. They die very quickly. And so if a fund has been operating in the industry for a longer period of time, it must mean it's a better fund. Assets under management, how much money are they managing? Again, related to performance. If a fund has high assets under management, there could be many reasons how he got that. But one of the primary reasons is because the fund performed well. When the fund performed well, what people will do is they say, look at that fund, it's really well, performing well, I'll invest in that. And as they put more money in that fund, the assets under management will grow. And again, indicator of good performance. Fund manager's profile. When I say fund manager's profile, I'm not talking about his picture. I'm talking about what kind of a background he has. How many funds he has overlooked. How long has he been in industry? How many successful portfolios does he manage? So these are all important to understand this portfolio manager, fund manager. And of course, historical performance. Historical performance will always matter. The problem is this, that we kind of extrapolate from there. We say, well, if he performed well today, he will definitely perform well tomorrow. But we need that link that says today if he performs well, he's more likely to perform well next period. How can we get that link? It is through a couple of these measures. One is alpha. Not a simple alpha, but the significance of alpha. Have you guys looked at that? Significance of alpha with Ralph? If you haven't, don't worry, you will look at significance of alpha with me in AFM. But at the moment, all we are looking at is the alpha that the fund manager is producing consistent? Can he make alphas positive every period? I mean, here's there could be one fund manager, and I'll show you this because I give this example, and you'll probably see this example in the class later on. You can have two fund managers. Here's fund manager alpha for fund manager 1. Here's the alpha for fund manager 1, alpha for fund manager 2. And I have 4 periods over which I'm looking at the alpha. Fund manager 1 performs 1% on the first time, minus 2% the second time, 3% the third time, minus 1% the next time. So what is the average alpha? Average over 4 periods? 0.25? Yeah? 4. Oh, I think I got that right. 1 minus 2, 3 minus 1. Sorry, that looks like animal. It's supposed to be 2. Is all good? So that should average. I've just averaged out over 4 periods. Yeah? And then I have fund manager 2. He does 0.2, 0.3, 0.25, 0.25. What's his average? You do realize that I've done this number so many times. I'll make sure that I get 0.25. If I had to invest with a fund manager, which one will I choose?
Second one.
Why?
Consistency.
That's the answer. He's consistent. He's stable. You know that he's generating alpha in every period. This guy is all over the place. It looks like he's being really lucky. He's lucky over here, horribly unlucky in the second period, great, amazingly lucky in the third period, unlucky again. So you won't, although average alphas are still the same. So when you're measuring the alphas, you're saying, oh, both fund managers have the same alphas. But you have to now consider the alphas over a period that you say, is he consistent or not? You know, time passes so fast. I just looked at the time, it's almost 3 o'clock, and I'm thinking, thank God I have 1 more hour with you guys. No, don't, it's okay, don't panic. She's not even panicking, she's like going, what? Then we come and look at the fund manager fee. A manager will charge fee for his efforts. A passive manager will charge less, an active manager will charge more. However, whenever we consider fund managers, we must consider their performance after fees. So we must understand how they've done after fees. And the last one we're going to talk about is investment strategy. How did he generate those investments, those returns? So we'll talk about that in a bit. Very quickly, I'm just going to go with the passive funds. Most passive funds come of the type of open-ended funds. They are the largest investment in the market, but you also have a lot of ETFs. In fact, given Professor Zubrug's talk on day 1, he must have said that the market is moving towards passive investments, and not just passive investments, low-cost passive investments. So ETFs are quite becoming a dominant player in this space. Investment strategy, as I mentioned, all they have to do is follow an index. It's straightforward. And again, for that, they pay the S&P fee. S&P gives them list of assets and exactly how much they should invest in them. If I do that today, if I take my money and invest in all the assets in S&P in exactly the allocation they tell me, I've created the S&P index. From here on, it becomes a buy and hold. I don't have to do anything. I'll just be following like the index. So investment strategy is pretty straightforward when you're fully replicating, but for those engineers out here or those people with strange mathematical minds, and not just mathematical minds, but also restless minds, you can create index funds by using far fewer assets than the index itself. For example, you can create an S&P 500 index with only 25 assets. You don't need 500. And that's the beauty, because your transaction cost goes down. So you can create interesting investment strategies. Management fee, passive funds always lower. ETFs the least. Performance, how do they report performance? Ladies and gentlemen, they will always report performance before fees. The reason they do that, they want to make you understand that their performance on a gross basis is exactly like the index. And then you take the fees out. And the measure they use is only one. There's only one measure, tracking error, nothing else. How large can the tracking error be for a passive fund? And the answer is it should be around 2% or less. If it's more than that, it might be, it's not being fully replicated, it might be sampled or quadratically optimized. So generally a 2% benchmark is what we're looking at. Active funds, they're a different beast altogether. Fund types, you can have them in everything except ETFs. ETFs are index, but you can have open-ended and closed-ended. Most of the closed-ended are either small caps or industry indexes, funds, or they can be real estate. Investment strategy, there are a couple of them, fundamental or technical. Now, do you understand the difference between technical investment strategy and fundamental?
Fundamental analysis.
Fundamental analysis? Yeah. Fundamental analysis where you actually understand the firm, understand the industry, understand the competitive environment, and then invest. Technical, on the other hand, is more patterns. You look at how and you'd be surprised, Rudy, that every financial institution has technical analysts. Yes. You know, people say, oh, markets are efficient, so there should not be any technical analyst. We have technical analysts. And so for short-term movements, markets are not that efficient, and we can use technical analysts. But for longer term, I think fundamental is better. Fundamental analysts are charged slightly more because the analysts cost more money. But these guys are coming up, so the quant funds are increasing. Management fees. Management fees are always higher. Active funds, higher fees. They can go up to 2.5%, and sometimes when you add on the incentive fee can be another 15%. So they can be quite high. How do they report performance? After fees. Now, you must make sure that when you consider active funds, they must be looked at after fees, not before fees. Because you can have a very good performance before fees, but then with a very high fees, the performance goes down. And the performance measures that we are going to look at are only three: alpha, Sharpe ratio, and tracking error. I've put down some active investment strategies. We have the technical quants, which are coming from then we have the fundamental strategies, value growth, and sector rotation. Then you have the long, short, and leverage strategies of hedge funds. And what I want to just mention over here is that we must understand the investment strategy. So from here on, we will now engage in actually looking at funds. So let's start with how do we look at funds. Ladies and gentlemen, do you need a break or you guys are good to go? Another half an hour. Is all good? That table? Do you have your mother or we or that caffeine drinks? You have them? Share them on this table. All right, so what we'll do is we'll get into a website called, as Rudy mentioned, Morningstar. Okay. Oh no, not this one. I think I don't know what that was, man. Alice, can you see from back there?
Yes.
Good. So as long as Alice can see, we are happy. Alice and Lee. Lee, you can see as well? Good. What we're going to do is we're going to try to select funds and understand how we do that. So let's start with funds. So you click funds over here. And when you're trying to search for funds, you can go with this thing called Fund Screener. So I'm just going to click that. So, how many funds in the Australian market?
9,280.
Good. 9,284. This, for your assignment, you have to look at each one of them. No, I'm kidding. That's why we're doing this. So what we're going to do over here is that we're going to select funds based upon an investment class first, as a class, and then delve down. So let's start with our idea about, if you turn to, you remember we were looking at the sample investment strategy, where we had the sample investment strategy roadmap for roadmap. Just on the page where we're looking at equities, I can just pass this on to you.
It's okay. It's okay.
You sure? We're going to look at this, which is fixed income. Just the first one, fixed income securities. Now, what do they say about fixed income securities? So, they say that this is fixed income allocation are to provide current income to support operating cash flows to create some measure of diversification. As a result, both credit quality and preservation of principal are a core emphasis of this allocation. A current risk for cash and high quality fixed income is the possibility of negative real returns. That can happen. So when inflation goes up, your returns can go down, or returns which are less than rate of inflation. That can happen as well. No more than 15% of the entire portfolio should be invested with a single fixed income manager. In this case, how much did we have allocated to fixed income securities? And the answer is, I think, 10%. So let's try to find one fixed income securities fund manager for this purpose, just the one. So what I'm going to do is, of course, this is we're looking at something which was US. I'm coming back to Australia, but that should help you out. So what we'll do is we'll look at, first up, we'll just, okay, it doesn't matter. Category. So we go into category and we choose a category over here. Now notice what you have over here. There's a lot of things that will come up. So you have alternative strategies, diversified, Australian cash, Australian short term, Australian bonds. Yeah? So I click that. So now we have only 323 funds. All right? Now, what else do we want in this fund? What else do we want? Well, we can consider performance measures. So, for example, we can look at 1 year return, which should be a minimum of how much is that? That should be more than 0, no? No, I'm not going to get anything. All right, forget that. I think I'm going to do some performance measures. Okay. So I've chosen a standard deviation over a 3-year period, which should be less than 15%. I don't think that, oh yeah, it killed off a few funds. It didn't kill off a lot of funds. I can then also look at a Morningstar rating. So over here you'll have something called a Morningstar rating. And the highest rating that you can get is 5-star. But you can consider funds that are of lower stars. So for example, you can have funds which are 1 star, 2 stars. So at least if you want to have, So this ensures that I get funds which are 2-star, 3-star, 4-star, and 5-star, right? I didn't highlight this one. If I highlight this one, that's also 1-star. So if I de-highlight this, I get only 2, 3, 4, and 5-star. And if I do this, I only get 3, 4, and 5-star funds, yeah? I can also consider, yeah, all right. So from here on, I have a whole bunch of funds which are available to me. It tells me about the fund name, its ticker symbol, its ratings, the category invest in, and the asset class. I'm going to take, here's the problem, I don't think I can have all of these funds, so I still want to choose one of these funds. So I'll take a look at the first fund, which is called Aberdeen Australian Fixed Income. This is a report generated by Morningstar. This is not a report generated by the fund company. And over here, it shows you a couple of things. First, it'll show you how the fund has performed. It'll also tell you the index, what the name of the index is, and how it has performed against the index. So it looks like it has tracked the index over here. And here's the category. Category is the peer group. So how did others in the peers perform? And you can see that that is the green one, which is over here. So it shows that Aberdeen has performed better than its peer group. What else do we know? Aberdeen was... All right, there you go. It gives you some other details. Over here it tells you about the last 1 month, last 3 months, last 1 year, last 3 years, and last 5-year performance. These are its returns, and how it has performed against the category, that means its peer group, and how it has performed against the index. Now notice what it has done. In the last 1 month, it has done positively against its peer group and positively against the index. And it's ranked 25th out of 98 funds in that category, yeah? And so you can see that over 5 years, of course, there were less funds at that time, and it was 16th out of 73. It gives you other measures as well. It gives you the standard deviation, fund, category, Sharpe ratios. It gives you the beta, but in my case, my thoughts are that don't look at beta. Beta is only useful when you look at equities. When you look at fixed income securities, betas are not relevant. And it provides you an alpha. All right, so it shows you it's a negative alpha, but it's not a severely negative alpha. It's still a negative alpha. It tells you some more details over here. It tells you what is the entry price and what is the exit price. The entry price and the exit price are prices above and below the net asset value.
Just like bid and ask.
Just like bid and ask. And so when you want to buy the fund, you will have to pay this. But for the same number of units, when you sell it, you'll get this. So you get less than what you paid for. And that difference is the transaction cost to invest in this fund. When was this fund created? 8th February 1993. So this fund has been in existence in the market for a fairly long time. And it shows that as a valuable, that's been there for a while, it's positive. Who are the fund complex name? Aberdeen Asset Management. It's a very large fund complex. And so there's a reputation attached with large funds, large complexes, that they are safe, they're conservative, they look after you. However, the other side is that when you look at young funds, just like you young people, you are more aggressive. You have ideas. You don't want to be restricted by the cages of society. Sorry, cages of confinements of the world. So you can bring in more aggression and exciting aspects.
I think it's a British fund manager, not Australian.
Sorry? Yes, Aberdeen is, yeah. And if I'm not, yeah. But they have a setup over here in Australia as well. So these are domiciled in Australia. But you're right, the complex is from UK. Base currency, Australian dollars, it tells you how much is invested. It also tells you the minimum investment. Now, if I ask you, how do they invest? What's their investment strategy? You say, well, actually, there's a bit written over here. No, it doesn't say anything. It doesn't say anything. So if I ask you, what kind of fund is this? Is it active? Is it passive? What does it invest in? What's its investment strategy? You have no idea about that. Where can I get this information from? To do this, you will copy this name, and you open another tab, and you print over here this. And next to it, you can add fact sheet. And here comes your fact sheet. I hope it is. And just, oh sorry, I'm just going to make it bigger so you can see this. So I actually went into the Aberdeen Management Company's website. So this is not run by Morningstar. What you previously saw was provided by Morningstar. This is not by Morningstar. This is from the company itself. And on this side, you have a couple of documentation. You have the fact sheets. These are done on a monthly basis. PDS and other information. I just want you to look at this. Just one document. It's a one page, sometimes 2 pages. So I'll just click this. Nice colors as well. I like dark blue and light blue. Works really well. So, what does this company do? Investment objective, to provide exposure to primarily Australian fixed income securities, so we know that, to generate income with some capital growth potential over the medium to long term. The fund aims, is it active or passive? The fund aims to outperform active the Bloomberg Osborne Composite Bond Index over the suggested investment time frame of 3 years plus. Cool. So we understand it's active. How does it do that? To aim to actively add value through interest rates, credit, relative value, strategies, they do whatever they do. But on the side over there, they have given some very interesting information. They show you this is the fund position and this is the index position. This is by the different sector holdings. These are by durations, credit durations, and so on and so forth. And then you have and it shows you that it has a higher weighting than index on cash. It has a lower weighting than on government. It has lower weighting on semi-government. It has higher weighting on corporate. So this is obviously, it believes that the economy is going to improve and perhaps you get a higher returns from the corporate segment. And so you notice that they are trying to differentiate themselves against the benchmark. This is the benchmark. How do you generate returns? Think about what is undervalued. It could be a single asset. It could be a sector. So over here we have that. So you have your durations over here, credit durations. You have your credit rating profiles. For me, because you guys are looking at from fixed income securities point of view, this is perhaps the most telling. So it has decreased its modified duration against the index. What is it saying about the future?
I mean that the interest rate is going to increase.
Simple. Now, this part, remember I was talking about some kind of an opinion by somebody other than central banks. Every fund will tell you something about the future. They'll have a performance review, what happened in the past, and then the market review, what's going to happen, what their opinion is about the future. You don't have to do a lot of work yourself. So those ideas that I was saying, generate, work out what the forecasts are, you don't need to do any of this stuff. It's already provided to you by, it's not going to be the same for every fund manager. Every fund manager will have a different opinion, but at least they'll give you something to think about. How these are going to move, how Australian bonds or US bonds are going to move, how the European bonds are going to move, and so on and so forth. It's a wonderful source of information about market condition. Now, let me just go back and do something slightly different. So instead of looking at bonds, let's look at, oh, there you go. We're going to look at equities, because in my mind, equity is a lot of fun. All right, now. Take a look at the US equity, Australian equity. Australian equity is large geared. Large cap, geared, which means they are leveraged. Australian equity, large growth. This is an active investment with a strategy which is called growth investment strategy. Again, active investment with a strategy which is value investment strategy. And one of the things I mentioned in my overheads that I didn't go through is that these two investment strategies don't work exactly the same way. I think we're discussing it in the lecture at the moment in AFM. Growth investment strategy does well when economy is cooling off, and value investment strategies do well when the economy is warming up. However, this is just a general opinion. It doesn't mean that only value will do well when the economy is growing and only growth will do well when the economy is falling. Both of these are required or thought of as trying to generate abnormal returns.
I think over the long term, value will outperform.
I'm not going to say that. Okay, now that you've started it, Hussein, I have to answer you now. The reason why that has happened is because value generally does well when economies are growing, and generally economies grow. So that's why value generally does well. There's another reason for this. It's easier to identify value investments. It's more difficult to identify growth investments. And if you were thinking value only means large cap and growth only means small cap, that's not the case here. There's something called a blend. I love this term blend. Oh, where's the large cap blend? Ah, here, large cap blend. What's a blend? Blend combines various investment strategies in one portfolio. So they might have different analysts, different kind of portfolio managers, all trying to generate abnormal returns from different sources. So a blend is a combination of various other active investment strategies. So let's say we are trying to get a large blend. All right, part of your assignment requires you to look at large Australian investments. And for our assignment, you need at least 2 Australian equity fund managers. Now my question is, how are you going to divide those two? How are you going to, what segment, how are you going to say, what kind of a fund manager do I want? Now, to show you that, this is what my portfolio looks like. I'm just going to make it into a box. Here's your cash, which is 10%. Here's your bond, which is 20%. Here's your equities, which are, how much is your equity in your assignment? 40. And then you have developed, 20. And what's the last one? Emerging is 10%. So let's look at equities. I think by definition you need at least 2 fund managers. Yeah?
I think 4.
4? Is it 10%?
No, I don't know, but I'm
No,
gonna
no.
put more.
Over here. So it says over here, Australian large cap, at least 2 funds.
Okay, fine.
Yeah? At least 2 funds. So you need to find at least 2 funds. What should those 2 be? They're large caps. How do I define those 2 funds? What will they be? Should they both be active? Should one be active, one be passive? Should it only be passive? How do I decide? So, depends on your objectives. Now, this is where we actually want you to think about. How will you invest in these funds? How do you decide on these funds? A simple would be passive, active, and you say 20% passive, 20% active. I mean, this would be the simplest case. Except that if I ask you, well, why did you choose 20% in passive? Why did you choose 20% active? Because these are the questions you're going to get in the presentation. You go, oh, well, Aku said it's the easiest way to do it. so you'll have to have a justification more than that. So the way I think about it is, passive provides exposure. Active provides less exposure, but with the additional benefit of abnormal returns. All right? So, if I go active, I reduce my exposure, but I increase my abnormal returns. If I keep passive, I increase my exposure, but of course I'll have zero abnormal returns. So what do I want to achieve? And this is where each team will differ. But let's say I go with 20% passive just for my exposure and 20% active because I want to generate abnormal returns. How will I do that? I'll go into the blend. And I've decided I'm going to use large cap blends. All right. I'm sticking with the same idea, except I'm going to remove this this standard deviation. I've got 4,633 funds. Do I? Well, I think I got it.
You are selected them.
Oh, did I?
Yeah.
Oh, category. Oh, okay. Yeah. Okay. So done that. Morningstar ratings, what would you guys like? So we're down to 598 funds. Any other things that you want to talk about? Fees. So maximum management fee. How much would you like? So that leaves 496 funds. Anything else you want to do? Performance risk, maybe? So I want the last 1 year's return should be, no, not last 1 year's, sorry. Last 10 years returns should be greater than, I think this is 5%. I don't think this is showing up, but I think this is 5%. So 0%, 5%. All right, I've got 367 funds. I'm not going to play any longer, but you guys can do that on your own. So this time I'm going to select something from. So when we have these presentations and we see students coming with funds that start with the letter A, we know that you've only looked at the first couple of pages. So I'm going to go. Somebody has a preference for a particular fund complex?
Schroeder is not bad.
All right, Schroeder's.
I think the Burgess one. The others one.
Yeah, I think I should have started with. Ooh. There you go. All right, so Schroeder's Australian Equity Fund. Okay. It tells us the details. Yeah, it did fantastically well over here, and then it started underperforming in this period, and then it started outperforming again. Wonderful. This matrix tells you that it's large cap, so this axis is large cap, value, growth, and blend means combination of these two. Yeah. Let's take a look at the fees, although I know you already selected how much fees we can pay, but still, the fees over here is, where did the fees go? Management fees, 0.62%. All right, so it's a very low fee. This fee is, usually you won't find such low fees in active funds. Conceived in 1964. That's older than I am. Older than you?
Exactly.
You're older?
Yeah, no, it is older.
We are both younger than this?
Yeah.
That's what I want to hear. Not for long though.
More than the 50.
So this fund is 53 years old. What else do we have? We have the company's name, Schroeder's, as Hussein mentioned, it's a very famous brand. But take a look at the minimum investment. This minimum investment of $500,000 means this is not for you and I. This is going to be for a large institutional investor. So when you're choosing a fund, do keep an eye on this, right? Now, yes,
Is
sir.
it appropriate for
Wholesale.
wealth management?
Yeah, yeah,
Or would
yeah.
it be
For sophisticated clients.
Yeah, but even then, if you're looking to diversify, 500,000 is a large amount of money for any one individual, for most people. I'd say,
So this-
but
the-
even for people under wealth management.
I'm sure there's a retail option available. It will be more expensive with a lower entry requirement.
Yeah.
So, yeah. But again, what we don't see over here is why did it perform the way it performed? So what we're going to do is exactly what we did last time. Copy this. Oh, sorry. There you go. So what do they do? Bless you. I think they're really into commentary. Look at the commentary. I mean, you can get a lot of information from this. Yeah?
The course material is going to be easier.
I know. I can just cut and paste from here and give it to you guys. All right, fund objective, to outperform the S&P ASX 200 accumulated index after fees over the medium to long term by investing in a broad range of companies in Oz and in Kiwi land. What's the investment style? Shude is a bottom-up, fundamental, active growth manager of Australian equities with an emphasis on stocks that are able to grow shareholders' value in the long term. So this provides you with even though they said they are blended, but it seems that they are more growth-oriented than blend. So remember in this previous case, over here they said that their style is large cap blend, which is a combination of growth and value, but the fund manager is saying we are actually large cap growth. That's what the fund manager is saying. What else can we show? Oh, this is what I want to show you. So performance. This is before fees. Always before fees for active investment. Shooter outperforms over here, underperforms, outperforms. Over the last 10 years, which is a good indicator, long term, it's outperformed by 1.77. So its fees is about 70 basis, it's outperformed by 1.77. That means after fees, it's outperformed by 1%. Yeah? What else has it done? This is the portfolio, this is the benchmark. Where is it investing? So it's taken money out of the ASX 50, the top largest 50, it's reduced its weighting against the benchmark. It's reduced the weighting in the next 50 as well, and the next 50 as well, and the next 300. This is where the allocation is going. So they've reduced that, and it's gone to non-index and cash investment. It could be private equity, I suspect, or assets that are not within those ASX 300. So because they say they are talking about the 200, I think it's outside the 200, or private equity. This is another aspect that is very important. This tells you how they've defined mispriced securities. By the way, this is for the last period, right? This is ending February. What did they go high on? NAB, ANZ, BHP, they were pessimistic on CBA, pessimistic on Westpac, pessimistic on Rio. So they decided that some banks should be overweighted because they were better, and some banks would be underweighted. Again, some resource companies are overweighted, some resource companies are underweighted. And so this overweighting and underweighting is going to generate the abnormal returns. Yes, sir? Yeah, they underweighted. They overweighted Rio Tinto. Oh, they've done overweighted BHP as well. And Illumina, they've overweighted the resources. They've overweighted the resources. And I think that would have worked out well for February. This is ending, this is in February, so this is for January. I think they must have done pretty well. No, they didn't. They didn't.
The resources performed very well. Iron ore just soared.
Yeah, but I think they got hammered somewhere else. I don't know where. So this is the largest allocation. Take a look at that, 51. That's half of their portfolio. Sorry?
Woolworths maybe. Woolworths.
Oh, yeah. Well, Telstra, they were negative on Telstra, and Telstra did not so well.
I thought Woolworths took a bit of a beating.
Yes, and I think they were going to go on Woolies, but not on Coles. So CSL is not here. Anyways.
But a question, please. Do you call this active or enhanced indexing? Because I'm seeing that the top players are always investing in most of them. Okay.
Just answering this question. Hussein is asking a very intricate question. He's saying, is this truly an active fund, or this is a conservative active fund?
Yeah.
So enhanced index is a conservative active. It's almost like the index with just slight weight changes. We can judge that with the tracking error. So as I mentioned, passive funds have very low tracking error, about 2% maximum. This is slightly above that. It's not a huge tracking error, and you're right, this is a conservative fund. And the conservativeness would be basically because of its size. So if I go back and I take a look at this, I mean, Shruti itself, 1964, it was born. This fund would have large assets under management. There you go, 1.2 billion. So it's a decently large investment over here. The moment funds become large, ladies and gentlemen, this is the case not just for funds, but also for human beings. No, it's true. Once you rise to a certain level, you become very conservative, because at that point your salaries are high and you don't want to do anything to disturb that salary. When you're young, when you're at the entry level, you can take risks and you can try to get up faster. So advantage of young funds, they're more aggressive. Advantage of old funds, they're more conservative. You choose what works for you. You can have a mix of the two. Sorry, it's really? There you go, sectors. I just wanted to go with the sectors. So that is how they're showing how they've overweighted or underweighted the sectors. So apparently, the largest positive is in the resources. They were negative on the REITs. I think this REITs negativity is understandable, given that interest rates are going to rise. So when interest rates rise, real estate will get affected. Healthcare has been downgraded, which in my mind, I'm a bit surprised at this, because I thought healthcare will be doing well, but somehow I think that, and this is the outlook over here. All right, so they give you why they're doing this. So, ladies and gentlemen, when it comes time to, so you guys already have your assignment. What I would like to do is that over this period of time, I want to meet with you as a group, where it doesn't have to be once, it can be repeatedly, where you make an appointment with me, show me what you're doing, and discuss with me so I can make sure you're going in the same certain direction. The reason is because there's going to be a presentation, and I'm one of the assessors, the other one is Professor Zubrug. And I don't know how you feel about Professor Zubrug, but he is not just a professor, but he's also the head of school. And he doesn't have a lot of time. So to minimize wasting time, I want you guys to have the best impact on your assignment. And of course, that also means you get the best marks. This is not required. You don't have to come if you don't want to. But if you want to, I'm available for you. So I'll send you details of how to make appointments and come over and see me. That's all I have for you guys today. Thank you so very much, and have a wonderful, wonderful day. Thank you.
Do you think that if we'll do this assignment individually, I will not have any problem with the timing?
I don't think. How many courses are you doing?
Myself?
Yeah.
I'm doing the full time, the full courses.
I think you should be part of the group.
Okay. I consider also that if you have, that it's limited time, I don't think that they will allow me to have my own presentation.
No. That we can arrange.
Okay, fine.
But my problem is just that it's maybe too much work. However, given your background, you might be able to do it on your own.
email for me.
You have no problem.
I just was concerned that you guys, if there have been a problem with the timing that day.
No.
Other than that. But
But if you're a CFA holder, what are you doing over here?
I just wanted
This
to
is
get the-
baby stuff for you.
Anyway, okay. I'm sorry, I didn't get your name.
Syed.
Syed.
Yeah, Syed, yeah.
Okay, Syed.
Syed Akbar?
Syed Akbar.
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 Akbar. Okay, fine. Syed Akbar. Okay, fine. Yeah, Syed the Greater.
Yeah.
Okay, fine. If you don't mind, can we communicate over the email?
Absolutely,
Okay,
absolutely,
so I'll just come
absolutely.
and- I'm sorry. Are you the lecturer who gave the previous one?
No, no,
different.
that's Professor Zubru.
Okay, fine.
So
okay.
you'll see him next time.
Okay, great. Okay. Have a
All
good
right.
day.
Thank you. Hello.
Can we finish that assignment by 2 people because we can't find the last one?
No, there's one more. All of them have been taken up. No, sweetie. Okay, this.
Yeah.
Look, can I ask you, Hussein, do you want to join this group, or no? You're more happier doing it on your own. Is there anybody else who wants, who is not in a group? Because these
I don't know. They three of
who? Rudy,
Rudy's. They got another three actually.
you have.
No. They are three. So
Okay, so you're not in a group.
no. All right.
Perfect. So now you guys have to figure out what session you want. Rakib, where do you work?
Actually, I'm working in customer growth, not in the finance sector. Before I'm from Bangladesh.
I know you from Bangladesh.
Yeah. So I work in a bank actually.
All right. Oh, okay. Kia, he worked in a bank before. Harley.
So the session is in the email, right? When we report the group.
Ya. Saya mau tulis lagi supaya semuanya tahu bagaimana.
Thank you.
Bagus.
What's the harder version of the assignment? Just out of interest.
Actually, the harder version is selecting the funds and why you select those funds. Because for most people, they'll select the first couple of funds which have the 5-star rating and stuff like that. And in our minds, that doesn't show. So it gets even more difficult once you go into the developed and emerging markets. Because in developed markets, you have so many different segments to look at, and geographical as well as industry. And it becomes a little more difficult. Similarly, emerging markets are even more difficult. Emerging markets, because everybody is from an emerging market except for us, everybody wants to put their countries in the fund as well, which is
familiar with emerging markets this way,
Yeah.
which is one of the flows of the first behavior.
So, you from Cairo?
Yeah, I'm Egyptian, yeah. But I moved to Australia a couple of years ago, so I'm a PR.
Couple.
Yeah, a couple
Oh,
of years.
okay.
I've been here since 2000.
I was there in Cairo
Yeah.
when Sadat was
I
assassinated.
moved here a couple of years ago, not Kabul.
Yeah, I know.
It's okay.
But I went to Egypt when Sadat was assassinated.
Okay,
Just
that
before.
was 81. Okay.
So,
But I just worked there for like 5-6 years, and then I spent a year in New York. I was working for AIG,
right.
and then moved to Dubai. So over the past 10 years, I was in Dubai. Because of what's happening after the Arab Spring, I decided just to come to
No, and plus, I think Dubai is a wonderful center for financial markets. I have hundreds of friends who live over there,
Yeah.
and most of them are in the financial or the tech sector.
I think I'm from Pakistan.
I'm from Pakistan.
Yeah, because I worked in 2004, 2006, I worked at Masher Bank. And most of the
Ah.
people at the surgery were Pakistanis. So they're very
It's amazing how many brownies are in finance.
Yeah, maybe. No, I'm mainly Pakistani.
Yeah.
And after Pakistan, especially the treasury.
Yeah, that's
I think it's because Islamic banking is becoming very
Oh,
important
okay,
in
all
the
right,
Middle
right.
East.
Right,
So
right.
it's especially in Dubai and
Right,
GCC.
right,
So
right.
Pakistanis, because they're Muslims, they have, and they also have they're good in in finance.
That's
so
what,
they've got both.
because I don't understand why they go to finance, because our finance in our country is actually fucked up.
Yeah,
So,
they're about Pakistan.
yeah.
Yeah, I don't know, but
I mean, I moved here about 95.
Wow. Okay, no, I just moved there 2015, a couple of years ago. And and then they told me that that you have to spend a couple of years in Adelaide which is part, it's a more obligation, not really a legal one.
我的这些行业比较传统，我不知道雨林那边会不会好一点。哦，然后我有看 PM 嘛，我的 PM 是很多是不太高的，像3.1啊，这个找不到 PM 大概算一下，这个是4.7，反正我5以下的我就觉得，13以下的我都觉得它比较多就是那种对，就是因为它整个我看的这个 industry， 它的整个行业的平均是13.3，然后我只要低于13.3。怎么看的？有啊。software coverage，然后你看它整个行业，它每一个 sub 的它这一类都全部都是一样的，然后它的 PM 是13.3，就是 profit margin 是13.3，然后只要 profit margin 低于13.3，我就认为它是低的，很主观的就把它认为它是低的，然后所以我看的是右边这一列，不知道会不会就是它的是比较一般，然后他看这边是比较好，就是你看这个4.7是低的，14就高一点，这个没有算，这个11.2，这也不算高，然后这个3.39，然后还预计每年会有1.3的7.3左右。我们还有什么？
去看中医。我是你不准在看吗？也有看中医。
帮我拿一下子去。不孕。
不孕为什么要看中医？
你说不孕都是看中医嘛？那个老中医。天养功。
教室有没有摄像头？有。哎，不是，那个不是摄像头。
前面呢，这些都是啊，这些都是那个，就这样。对。
哪里啊？
哦，这个也是。
哦，那边呢？那个是。这个是 project。
这个是吧？这个不是。
哦，对，这个。
哦，我要去拿我的小白菜。小白菜。
还要去金啊？
不知道，我去买完牛奶，然后再想。
买完牛奶不应该马上回家吗？把牛奶放这。
不是我买那种，我不能喝牛奶，喝牛奶会长痘痘，我要喝什么那种 almond 或者 soy。